The year was 1888, and Wall Street pulsed with mechanical fury. Ticker tape machines clattered in relentless rhythm, spitting thin streams of abbreviated symbols and numbers into a haze of cigar smoke and desperate ambition. Clerks shouted quotes across scarred wooden counters, while chalk dust floated above walls of prices that shifted faster than heartbeats. In this cacophony of commerce, fortunes vanished and appeared with each metallic strike of the printing arms, leaving grown men either euphoric or devastated within moments. Most 15-year-old messenger boys navigating this chaos saw only noise, meaningless symbols to be delivered without question or curiosity. Richard Wyckoff saw something entirely different. Where others perceived randomness, he detected deliberate patterns within the apparent disorder. He watched the tape as if it were a living organism, noting how certain stocks would pause before surging, how volume would swell before significant movements, how wide price spreads would compress into narrow ones just before explosive action. Wyckoff developed a craftsman's patience for observation, staying after hours to copy sequences by hand, marking moments when heavy selling met stubborn resilience, when small orders moved prices disproportionately, when markets gasped like exhausted runners before breaking into new territory. He built a vocabulary of pressure and response, effort and result, treating each price movement as a deliberate footprint left by powerful operators rather than random fluctuation. By age 30, this same messenger had accumulated over $1 million, a staggering fortune when the average worker earned barely $800 annually. His transformation wasn't built on luck, connections, or insider whispers, but on systematic decoding of market behavior. During the 1907 panic, when trust companies locked their doors and seasoned traders faced ruin, Wyckoff's methodical approach to reading supply and demand allowed him to navigate the treacherous waters successfully, proving that beneath Wall Street's surface chaos lay discoverable order for those patient enough to learn its language. In his sparse office above the din of Broad Street, Wyckoff spread ticker tape across a scarred oak desk like an ancient scholar examining sacred texts. The mechanical chatter below meant nothing to him now. He had discovered something profound within the apparent randomness. While other traders chased rumors and mystical market theories, Wyckoff had reduced the entire complexity of price movement to three immutable mathematical relationships that governed every transaction, from individual stocks to massive market cycles. His first breakthrough emerged from ruthless logic. Price moves only when supply and demand fall out of balance. No cosmic forces, no market sentiment, no mysterious interventions, simply the mathematical certainty that more buyers than sellers drive prices higher, while more sellers than buyers force them lower. Wyckoff observed how periods of equilibrium, where prices moved sideways despite thunderous trading volume, represented pitched battles between equally matched forces. Victory belonged to whichever side eventually overwhelmed the other through superior resources or relentless persistence. The second law revealed that significant price movements required preparation periods proportional to their eventual magnitude. Like steam building pressure in a boiler, accumulation phases created the energy necessary for sustained advances. Wyckoff developed precise methods for measuring these cause and effect relationships, calculating how weeks of sideways congestion could power months of directional movement. A 12-week accumulation zone might support a 40-point advance, while a 30-week base could justify moves exceeding 100 points. He treated these relationships with engineering precision, measuring market energy like a disputed isn't, physicist calculating potential force. His third discovery provided the most sophisticated analytical tool, the relationship between effort and result. When volume surged but prices barely moved, hidden forces were methodically absorbing or distributing shares. When prices advanced easily on diminishing volume, trends had achieved efficiency and sustainability. Heavy volume accompanying narrow price ranges near resistance levels revealed supply overwhelming demand despite surface strength. This law taught him to read the market's true intentions beneath its deceptive appearances, distinguishing between genuine strength and elaborate facades constructed by the composite operator. His term for the aggregate intelligence of large interests who moved markets through systematic campaigns rather than emotional reactions. Wyckoff's most revolutionary discovery emerged from recognizing that markets moved not through random chaos, but through the calculated campaigns of what he termed the composite operator. a unified intelligence representing the aggregate power of large, informed interests. These titans of capital didn't simply buy when they wanted stock. They orchestrated elaborate campaigns designed to accumulate vast positions without alerting smaller traders or bidding prices against themselves. Like a master chess player thinking dozens of moves ahead, the composite operator followed a methodical five-phase sequence that Wyckoff learned to decode with scientific precision. The drama typically began with a violent selling climax that marked the exhaustion of genuine sellers and established the foundation of what would become a systematic accumulation zone. This initial phase stopped the prior downtrend through sheer volume of liquidation, often followed by an automatic rally as short sellers covered positions and opportunistic buyers emerged from the wreckage. But this was merely the opening act of a much longer performance. The heart of the campaign unfolded during the building cause period, where operators absorbed floating supply through patient, methodical buying that could persist for weeks or months. Prices oscillated within defined ranges while volume remained elevated, creating the appearance of indecision when actually reflecting intense competition between accumulating interests and remaining sellers. Wyckoff observed how each test of support met progressively less selling pressure as weak holders gradually exhausted their positions, while rallies faced systematic capping as operators prevented premature price advances that might attract unwanted competition. The most cunning maneuver arrived in the form of a deliberate deception: the spring. This calculated break below established support served a brutal but necessary purpose, flushing out any remaining weak holders who had endured the entire accumulation process but finally surrendered when prices violated their perceived safety zones. The breaks typically occurred on increased volume but failed to generate sustained selling, instead attracting aggressive buying that quickly restored prices above the violated support. Wyckoff recognized these false breakdowns as the final clearing of supply before the real advance could begin, treating them as engineered shakeouts rather than genuine failures. Recognition of readiness came through subtle shifts in market character that only trained observers could detect. Support tests required diminishing volume to hold. Rallies began extending beyond previous resistance levels, and the overall personality transformed from defensive absorption to offensive advancement. Wyckoff developed mathematical precision in measuring these cause and effect relationships, calculating how 12 weeks of accumulation within a 6-point range could justify advances of 30 to 40 points, while 30-week bases might support moves exceeding 100 points. His studies of the 1921 to 22 market recovery and countless individual stock campaigns revealed how these observable patterns offered unparalleled strategic advantage, transforming market uncertainty into a predictable sequence that separated professional operators from emotional amateurs who mistook systematic preparation for market indecision. If accumulation resembled a patient gathering in shadows, distribution unfolded as elaborate theater performed under bright lights. Wyckoff discovered that the composite operator faced a sophisticated paradox during exit campaigns. Having spent months methodically accumulating vast positions, these master strategists now confronted the challenge of unloading massive holdings into rising prices without destroying the very advance that made their efforts profitable. Where accumulation built foundations in obscurity, distribution required maintaining illusions of strength, while systematically feeding supply into every surge of enthusiasm. The drama typically commenced with buying climaxes that marked exhaustion of genuine demand rather than the beginning of sustained advances. These spectacular surges on enormous volume created compelling illusions of breakout momentum while actually representing the final gasps of authentic buying power. The subsequent automatic reactions, though appearing as healthy corrections to optimistic observers, revealed the absence of follow-through buying and the beginning of methodical supply absorption. During extended distribution phases, operators orchestrated their most delicate maneuvers. Prices ranged near peaks while supply entered the market through carefully timed selling that capped each rally without triggering obvious weakness. Heavy effort met diminishing results as advances traveled shorter distances despite larger volume, and strong opens faded into disappointing closes. What appeared as consolidation before the next leg higher was actually systematic unloading disguised as market strength. The most treacherous deception arrived through upthrusts, false breakouts above established resistance that trapped breakout buyers at precisely the wrong moment. These engineered moves occurred on impressive volume and generated widespread bullish sentiment, creating perfect conditions for final distribution into eager hands. Unlike genuine breakouts that sustained advances, upthrusts quickly reversed as operators completed their programs. Wyckoff's analysis of the 1,929 market top revealed this pattern with devastating clarity, showing how months of apparent strength actually represented systematic distribution that preceded history's most severe collapse, proving that euphoria provided perfect cover for professional exits. The relationship between volume and price movement became Wyckoff's most sophisticated analytical instrument, a delicate barometer that revealed the market's true intentions beneath its deceptive surface performances. He called it listening to the market's pulse, and once you learned to hear its rhythm, the beat became unmistakable. Where amateur traders saw only confusing noise, Wyckoff discovered a precise language of effort and result that exposed the composite operators' campaigns long before they became obvious to the crowd. When rallies generated impressive volume but produced narrow price spreads with disappointing closes, especially near established resistance levels, Wyckoff recognized the signature of hidden supply absorption disguised as strength. The market would charge forward with apparent enthusiasm, volume surging as if victory were certain. Yet the advance covered little ground and prices slipped from their highs by day's end. This heavy effort meeting minimal result revealed that accumulated interests were methodically feeding stock into the buying surge, creating illusions of breakout momentum while actually capping advances. The market was speaking plainly to those who understood its vocabulary. Supply was meeting demand head-on, and the bull's apparent strength was being systematically neutralized. Conversely, when sell-offs produced substantial volume but failed to drive prices significantly lower, particularly when accompanied by strong closes that lifted away from the day's lows, Wyckoff identified professional absorption occurring near support zones. True weakness should have driven prices much farther on such heavy selling pressure. But when it failed to materialize, market character had fundamentally changed. These episodes indicated that informed interests were treating temporary weakness as opportunity rather than genuine deterioration, methodically accumulating shares from panicked sellers who mistook systematic buying for market indecision. Perhaps most deceptive were movements that achieved dramatic results on surprisingly light volume, price surges or declines that looked impressive but lacked institutional sponsorship. While these moves created compelling visual drama, Wyckoff recognized them as unsponsored advances, prone to embarrassing reversals because no real commitment stood behind them. Like actors performing without an audience, these manufactured moves collapsed quickly when faced with any meaningful opposition, revealing their hollow nature to those who had learned to measure effort against achievement. The most sophisticated pattern emerged when trends achieved increasing efficiency over time, requiring progressively less volume to generate comparable or greater price movements. Wyckoff watched for those moments when advances began behaving like trained athletes, each stride requiring less effort for more distance. Rallies that extended while volume moderated signaled the hallmark of professional sponsorship, pressing an advantage without strain, indicating that the composite operator had successfully cleared opposition and could advance prices with minimal resistance. In the summer of 1921, after a brutal bear market had exhausted sellers, leading industrials staged a frightening break below months of well-defined support that triggered public capitulation. Yet subsequent sessions told a different story entirely. Heavier trading met only shallow declines, followed by quick recoveries that reclaimed the violated range. The effort could not produce commensurate result, revealing that the spring had accomplished its purpose of flushing out final weak holders. 2 weeks later, a clean surge through resistance unfolded on comparatively modest volume that carried easily the kind of effortless strength that refuses to tire and signals the beginning of a sustained campaign. By 1937, the market's pulse had changed dramatically. Rallies near prior highs drew impressive volume, but stalled into short advances with poor closes, while sell-offs began traveling farther distances with less commotion. The heartbeat had grown irregular, then began skipping an early whisper of distribution that preceded obvious weakness by many months. This subtle shift in effort-result relationships provided Wyckoff's followers with invaluable early warning signals, transforming market uncertainty into strategic advantage through systematic observation of the market's changing character. The glow of multiple screens replaces the mechanical clatter of ticker tape, yet the essential work remains unchanged. Modern practitioners of Wyckoff's method face the same fundamental challenge their predecessors encountered a century ago: extracting meaningful signal from overwhelming noise while maintaining the disciplined, systematic approach that separates professional analysis from emotional reaction. The transformation from paper tape to electronic markets required careful translation that preserved core insights while embracing technological advantages unavailable to the master himself. The foundation begins with weekly reconnaissance, treating extended time frames as the strategic canvas upon which shorter-term campaigns paint their tactical stories. Here, practitioners learn to identify the 12 to 30-week ranges that precede significant movements, mapping these zones according to Wyckoff's accumulation and distribution schematics while calculating cause and effect relationships through measured move techniques. A 22-week base spanning 15 points might justify advances of 40 to 60 points, while narrower ranges of similar duration suggest proportionally smaller potential movements. This structural foundation provides essential context that prevents getting lost in daily fluctuations while maintaining focus on campaigns that truly matter. Daily monitoring becomes the tactical intelligence layer where Wyckoff's effort-result principles find their most practical application. Each session offers fresh clues about market character through the subtle interplay of volume and price movement at critical structural levels. When rallies approach overhead resistance on impressive volume but produce narrow spreads with disappointing closes, trained observers recognize the signature of supply absorption disguised as strength. Conversely, when sell-offs into established support generate substantial volume but fail to drive prices significantly lower, particularly when accompanied by strong closes that lift away from session lows, systematic accumulation is likely occurring beneath the surface drama. Execution demands patience and structural precision that honors Wyckoff's emphasis on waiting for optimal conditions rather than forcing trades into suboptimal situations. Springs below established support that quickly recover on diminishing volume offer low-risk entry opportunities with protective stops placed just below the violation point. The modern tape speaks through time and sales data and order flow patterns, revealing when brief stabs under support snap back with tight, fast reclaims that signal genuine rejection rather than breakdown. These moments require no mystical interpretation, only systematic observation of behavior patterns that have repeated for generations. Position building follows the same methodical approach, adding shares at last point of support locations where successful tests occur on reduced effort, confirming that the market demonstrates improved result with contained volume. Risk management integrates naturally with structural analysis, using distance to invalidation levels for position sizing while maintaining systematic stop placement that respects market logic rather than arbitrary percentages. When weakness appears, practitioners ask disciplined questions about effort versus result. Did heavy selling truly push prices far, or did it stall and lift, hinting at professional absorption occurring beneath apparent deterioration? Exit strategies focus on recognizing distribution characteristics that signal campaign completion. Unsponsored surges near measured objectives invite systematic scaling, while upthrusts that fail on retests provide clear closing cues. Heavy volume meeting narrow results near resistance levels, or any deterioration in effort-result relationships, suggests that the composite operator has begun methodical distribution into strength. These signals require neither prediction nor emotion, only systematic recognition of changing market character. The complete system demands continuous review and refinement, treating each campaign as educational material for improving pattern recognition and timing skills. Screenshots and detailed notes become living records that force honest assessment. Why the entry? What the tape revealed? How results compared to expectations? Success emerges not from prediction but from systematic observation, asking the same disciplined questions every trading session while remaining alert for subtle shifts that reveal changing conditions. Wyckoff discovered that order emerged from apparent chaos when approached with scientific methodology rather than emotional reaction, a principle that remains as valid in electronic markets as it was during the age of ticker tape and chalk-marked boards.